Ladies and gentlemen, in today's video, I will try to provide the strongest case to justify FutoTV undervaluation. I hope I will set a standard for all analysts using the internet as their main way to communicate with the audience regarding company valuation. For those of you not familiar with my work, welcome to the analyst. I've recently decided to change the focus of this channel to covering undervalued stock. Now, for a bit of background, FutoTV is a live TV streaming company. The company offers its subscribers access to various sport events, live news, and entertainment content through devices such as their mobile phone, their tablet, their smart TV, and their computer. The company itself has been performing well as far as the revenue generation is concerned. If you look at the financial statement from 2020 to 2021, you can see that the company revenue has grown over 100%. It is important to stress that they stated in their financial statement that 2020 and 2021 are not really comparable because 2020 represent 9 months relative to 2021, which is 12 months. Okay, but still, when you look at the performance, it is pretty clear that the company did pretty well within that period. However, the share price of the company has not been in line with that revenue performance. After peaking around $60, the share price of the company is now trading below $4. And the main reason that investors and analysts have been losing faith about this company is because the company operational costs seem to be pretty high and unsustainable. And the one that has been the focus of all the attention is the subscriber related expense, which is significantly higher than the revenue that the company generates per subscriber. If you look at the 2020 and 2021 data, it all looks like the company, for instance, buy at $1 and sell less than $1. But I believe that that concern has been a bit overblown. The concern is real, but I believe that the concern has been a bit overblown. And for the following reason. First of all, if you look at the company data, you can clearly see that as far as revenue per subscriber is concerned, the company actually generates a higher revenue per subscriber than the cost that the company incur. For instance, if you look at the data from publicly available, you can see that for 2021, the company generated about 72 and 70 average revenue per subscriber, and the company incurred 65.62 as the cost as the average cost per subscriber. So it means that there are additional costs that come into play to make this subscriber related cost higher than the subscriber revenue. And it all looks like the company think that they are capable of managing that cost and turn this business a profitable business. And there are evidence to say so. The first evidence is obviously the company last letter to their shareholder, where the company clearly stated that they expect to turn profitable or to generate positive free cash flow around 2025. They expect to generate positive free cash flow around 2025. And if you look at the quarterly financial information of the company, you will notice that uh, the subscriber related expense relative to the subscription revenue is not constant over time. It is not constant over time. It means that it is something that is clearly manageable. So, having stated all of that, I will make the following assumption that will drive my forecast of key data. First of all, whenever I look at a company financial statement with the intention of determining the company value, the key variable that I look at uh, is, or the key information that I look at is what the customer think about the company. And I will always try to uh, compare the company growth rate relative to the industry. And if we go back to just 2021 for the US market, you can see that the growth rate for this market was about 22.8%, right? The growth rate was about 22.8%. However, the company grew at the rate of over 100%. First, if you compare the company uh, subscriber size, you will see that the company grew its subscriber base. The company grew its subscriber base from about 500,000 to over 1 million, and that was translated to the revenue. It means that one, the company is growing faster than the industry. Two, that customers are finding value in the product of this company. And three, that the company is highly likely stealing customer from the competitor, which are all good information. After this one is done, the next thing that I have to do really is to try to forecast financial information needed in the model in line with the manager expectation. There is no reason for me to doubt the manager ability to generate positive free cash flow around 2025. However, I will be less optimistic than the management of the company, and I will make the following assumption. First, I will make the assumption that the subscription revenue will grow 1.3 times faster than the subscriber related expense. The second, I will make the assumption that the subscription revenue will grow 2.24 times faster than the broadcasting and transmission cost. I will make the assumption that the sale and marketing cost will grow at a trend growth rate of 7%. I will make the assumption that the technology and development cost will grow at a trend growth rate of 14%. And I will make finally the assumption that the general and administrative expense will grow at the trend growth rate of 8%. That I believe these are the key variable. Having said all of this, we can then go to our income, our revenue forecast for this company. And this is our revenue forecast for this company. All these forecasts till 2030 will be driven by the subscription revenue line, by this line right here. And this line is controlled. This line is controlled by the subscriber revenue growth rate and revenue growth trend. If I change, for instance, the subscriber growth rate to, let's say, 22%, you will realize that the income statement will completely change. The income statement will completely change. So now we can go back to our fair market value assessment and say, for instance, that let's assume that the subscriber growth rate is about 32%. It is important to stress that this company has been growing their revenue at a growth rate of over 100%. If we take 2020 in 2021. And the recent financial statement, in the recent financial statement, the company grew the revenue at the growth rate of over 70% in the US market. As you can see here, it is available in the management letter to shareholder. Okay, it is available in the management letter to shareholder. The company grew the last quarter revenue at the growth rate of about 70%. So if we assume that the company over our investment horizon is going to, let's say, generate a growth rate of 32%, I want you to focus on this table right here. This table, if you want, give the share price of the company as a function of one, the cost of equity for the first period going from 2022 to 2030, and the second period going from 2030 to the foreseeable future. And you can see that if we assume that the subscriber growth rate is 32% or that the revenue growth rate is 31.69%, you can see that this table is dominated by values that are currently superior to the share price of the company, which is about which is below $3 at this time I was recording this video. The table is clearly dominated by value greater than the current share price of the company, as you can see yourself, and the average price is $10. And it is very important to continue to stress that this company grew in the last quarter at the revenue, at the growth rate for the North American market of about 70%. Now, what if we believe that the manager is able to achieve the goal of generating positive free cash flow in 2025? That will only be possible if the management is capable of generating a gross profit around that period. The management believe that they can do so. We have data which shows that the subscriber-related expense, additional costs are controllable. And we have also data which shows that the average revenue per subscriber is greater than the average cost per subscriber. It will only be possible if, with the assumption that we made, that the manager is capable to grow revenue over that investment horizon at the rate of about 54.48% and the subscriber at the growth rate of 55%. This number can look a lot, but let me remind you that the subscriber base of the company is currently over 1 million, and just for the US size, the US market size, we are talking about 100 million subscribers. So if the company is able to provide value to their customer and grow at a rate higher than the industry, I think this is clearly possible. So if we assume that this is going to be possible, that means possible in terms of the manager being able to generate positive free cash flow in 2025. If we go, for instance, to our income statement, you will see that obviously 2025, which is in light blue, that the manager at that growth rate is going to be able to generate a positive free cash flow in the year 2025. And this is our income statement. What does that mean in terms of the fair market value of the company? You can see that if the management is able to achieve that performance, okay, the share price of the company currently will be a gross undervaluation. First of all, you can look at this table. There is no value lower than the current market price of the company. And remember what I said. I said everything that is in green is superior to the current market value of the company, and everything that is in red is below the current market value of the company. I will say, okay, maybe 50% growth is too much, it's unachievable. Let's assume that the management is going to be able to grow revenue at a rate of around, let's say, 37%. I believe that 37% or 35% is a possibility. And let's change the rate and see what we get. This table, remember, is a function of not only the cost of equity, but also the function of the revenue growth rate that we choose. For instance, let's suppose that the management is going to be able to grow revenue at a rate of about, let's say, 36%. And it is always important to remember that in their last quarter, the management were able to grow revenue for the North American market at a rate of about 70%. And what does that give us? You can still see that this table, which gives the share price of the company as a function of the cost of equity and the revenue growth rate, is still dominated by values that are currently superior to the share price of the company. More than 99% of the values in this table are higher than the current share price of the company. Only two values are below the current share price of the company. Only two values. That is, if I assume that the management is going to grow revenue at the rate of, let's say, 36%, or grow the subscriber at the rate of 37% over that investment horizon, as you can see. Now, let's assume that, no, 37% is going to be a lot. Let's assume that what is possible is a growth rate of, let's say, 32%. 32% meaning the revenue growth rate of 31% over that investment horizon. It means that if we focus our attention on this table again, the table is still dominated by values that are currently superior to the current share price of the company. And as you can see, we have table with values lower than the current share price of the company, but the table is still dominated, as you can see, the green area by value superior to the current share price of the company. I personally believe that this company, with the value it is providing to their customer, that they will be able to grow their revenue between 35 to 37% over the investment horizon. I believe that the company will be able to grow the revenue between 35 to 37% over that investment horizon. And that leads me, as you can see the table yourself, to conclude that this company is grossly undervalued. These are my expectations that are provided. This company is grossly undervalued, and the share price of this company should be between 20 to $25. I seriously believe so. So I hope you really enjoyed the video. I believe that this company can potentially surprise many investors in the future. It is important to stress that after I concluded this work, I decided to build a position in the share of this company, and I will continue to do so until the company return to fair valuation. I hope you enjoyed the video. If you have a different opinion regarding the valuation of the company, share that opinion with me, and I will see you next time.